You're probably using your HSA all wrong.
This is Retirement Revealed, where Jeremy Keil and his guests guide you towards making smarter retirement, investment, and tax planning decisions.
Welcome to Retirement Revealed. I'm your host, Jeremy Keil, and we're here to turn your retirement savings into retirement income. Today, we're talking about HSAs and how to get the most from your HSA accounts. And this really started from a few different things. One is that HSA maximums are released. The next year's maximum, you find out for 2025 how much you can put into the HSA in May of 2024. So that news came out, along with news from a place called the Employee Benefits Research Institute that's related to HSAs. But then even the government, the Consumer Financial Protection Board, they came out saying that there's a wide dispersion in the fees and the interest rates that you're paying. And it turns out you're most likely in a low interest rate, high fee account. So we're going to talk today about why your account might be costing you more than in general, kind of what you can do about that. I've put together some YouTube videos, so I encourage you to go to the Mr. Retirement YouTube channel. I'll put that in the notes. I've got videos there I'm releasing about HSA mistakes, HSA strategies, how to get the most out of your HSA, and even ranking the top 4 biggest HSAs. So the biggest HSAs by size, I go through, study the costs and the interest rates, and I rank them there for you so you get to see maybe which account might work best for you. But most of all, this came straight out of a client situation where they had a good amount of money, over $100,000 in an HSA. The first one I've seen over $100,000. I've seen quite a few $50,000 plus HSAs. But what's unique about them is that they were entirely invested in HSA bank account type products. So their interest rate was about 0.5%. And I was able to find them the HSA account paying 5%. When I ran the math and got them to move it on over, it's looking like they'll get about $6,000 extra interest from the same type of account, same type of investment. It's just in a different provider. So let's talk through today about HSAs, how to get the most out of your HSAs. And it's interesting about HSAs, some kind of tips and tricks here. I've got 3 mistakes that people often make. Number one being you're not maxing out your HSA. Quite often, you're not maxing out your HSA, and I'll talk through why that probably is. I meet a lot of clients with HSAs, and typically you think that the HSA, you can only add money into it from your payroll. And I can understand why you feel that way, because chances are you got introduced to the HSA through payroll. You know, the employee benefits come around every quarter, or every year rather, the fourth quarter, and you got to sign up for next year's HSA, and you put in like $100, $50 a paycheck, and maybe the company gives you $500 or $700 or $1,000, and you've put the money into the HSA through your payroll, but that's not the maximum. Just because you put money in from payroll doesn't mean that you can't put in more money. You can actually put in more money from not just from your payroll, and you can do more than that. And it's interesting how many people are putting money into their HSA, maybe at the $1,000 level, $2,000 level, and they don't put in more. I think it has to do a bit with my second reason or second thing you're maybe making a mistake on with HSA. So I'll get that in a second. But the maximum for 2024 for HSAs, it's self-only. So if it's only you covered by the plan, $4,150. If you have the family, whether it's 2, 3, 15, that's $8,300. And so you can max out. You can put a lot more money in the HSA than you're probably doing. One of the studies I saw showed roughly $3,000 is how much you're putting into the HSA. I was looking at some IRS tax data from 2022 that matched up. About $3,000 is your general HSA deduction. That's your average there in 2022. And you can put in a lot more than that. And one reason you're probably not putting in more is you're treating your HSA like an FSA, a flexible spending account, where you think you have to spend it every year. The HSA, health savings account, that can carry on throughout your lifetime, even beyond your lifetime. It's the FSA that you have to spend your money every year. And so I see what's coming in here. You get the ability to plug in from your payroll into the HSA. And because it's your payroll, maybe you had an FSA, flexible spending account in the past, you might think that it has the same type of rules. If you think that you can only spend your HSA money in the same year, of course you don't put in that much, but you can spend your HSA money in the future. You can max out. You can put in the $8,000 and only spend $1,000. You can spend nothing from it this year. So just knowing that an HSA allows you to continue on and hold on to the money down the road in the future, that should encourage you to put in more money to the HSA. And then the fact that an FSA requires you to spend every year means you might think that the HSA is the same thing. You don't have to spend $1 out of your HSA year in and year out. You don't have to take anything out of there. And so what comes in quite often to number 3 of a mistake that you might be making is you're not investing the money. Why would you invest the money? It'd be foolish to invest your money today if you're going to take it out in less than a year. That's generally interest rate type of situations where you're planning on taking the money out within a year. But with an HSA, because you can carry the money forward into future years, you could feel confident investing that money if you want to take on that growth risk and you're planning on using it years down the road. And you could use it years down the road. A lot of times, and this has been just recent, a lot of people are calling HSAs medical IRAs. Now, it's not an IRA. It's not the individual retirement account. It's not that IRA, but it works like an IRA, only better. The HSAs, you get a tax deduction today. As the money grows, it grows tax deferred. You're not getting a 1099 every year just because you earned interest or made money. And if you take the money out as a qualified distribution, as a health insurance type, not health insurance, I'll get to that in a second, but as a medical cost for a reason there, it's a qualified distribution, it's tax-free. So the HSA is truly the best tax account out there. And that's why there's a lot of focus on them lately. It's because you can max out your HSA. You can wait till later on to take the money out. You can grow it for the future through investing. So we've got those YouTube videos. Go to the Mr. Retirement YouTube channel to see some very specifics about here's the biggest 4 HSAs that are out there, ranking them bottom to top. And one account pays 0.05 and the highest account pays 5.0, 100 times extra interest. So if you are an interest rate type of individual, you probably want to get the most interest out of there. And one reason why you're not getting that most interest is you might not realize that you can move your HSA. Just because the employer set up the HSA at a specific place doesn't mean you have to keep it there, especially if you're no longer working. And maybe, yes, you keep it there because that's where the new money's going in, your payroll, and the employer match might be going in there, employer putting into the HSA might be going in there. But you can transfer parts of the account. You can move the bulk of it to the other HSA to get a higher interest rate. You can move it to the other HSA so that you can invest it for the future. And also what you can do is you can spend on your medical bills outside of the HSA so that it allows that HSA to keep on growing. So the real trick is you invest into the HSA, you max it out if you can. You spend on your medical bills, your doctor bills, and things that qualify somewhere else, and then hold on to the receipts. Because as long as you meet the rules on it's a qualified distribution, you can, it would have counted anyways. You could have swiped the debit card, you could have wrote the check out from that HSA. As long as they meet those rules, you can reimburse yourself anytime you want later on. And so that's the way to do it if you can, where you're growing your HSA, but you're holding on to the receipts. I like to see it when you put into a spreadsheet, because later on, if you do need the cash, and there's some reasons I'll get to in a second of why you want to maybe not wait too long to reimburse yourself. You don't want to have the world's biggest HSA when you pass it on to beneficiaries. We'll talk about that, but you can then reimburse yourself later on. So a few things here with the HSAs that you might not be aware of. You can actually take money from your HSA and pay for some insurance premiums. Your long-term care coverage, there's some rules based on the dollar amount and the age, and did you get a deduction on it on your tax return, but you can pay for some of your long-term care costs. You can pay for your COBRA coverage from your HSA. You can pay for your Medicare insurance, those Part B premiums. You can pay for your Medicare insurance on there. You can't pay for your Medigap insurance, but that's why a lot of people are calling this the medical IRA, is because just like your IRA is for the future, you can save your HSA, grow it for the future, so that later on, when you've got those long-term care bills, when you've got those Medicare premiums to pay for, or maybe you're below 65 and you got that COBRA that you're paying for to get you through to age 65, you've got a place already set aside to take out tax-free on there. Now, of course, you might be wondering, what if I have too much in the HSA? Well, keep an eye on it and actually have those receipts going where you could reimburse yourself. And maybe don't get too far ahead, but it's amazing when a lot of the big concerns you have in retirement is healthcare costs, not having enough money set aside for that, the taxes in retirement. The HSA really helps you towards both those things. Of course, if you do have too much and the money has to come out as a non-qualified distribution, it's called, there will be a tax penalty. It's a 20% tax penalty, so that's a hefty tax penalty. However, once you reach 65, that tax penalty goes away. So kind of worst case scenario is you put too much in the HSA, you turn 65, you take the money out as a non-qualified distribution, you pay taxes on it just like you would have as a traditional IRA. Kind of no harm, no foul. And of course, they don't want to hurt you if you get disabled or you die and goes to beneficiaries. There's no tax penalty on there. And you can pass away and move your money to your spouse as an HSA. So this is not just for you, but it's for maybe your surviving spouse, your widow, down the road too. But interesting enough, if there's money left that ends up going to not your spouse, your kids, maybe a trust, they can't keep that as an HSA. So unlike there's no inherited HSA situation for your kids and your trust. You know, that money will have to come out. There will have to be taxes on that. And interesting too, you could actually leave your HSA to charity. So just like a lot of times you leave maybe traditional IRA type money, your HSA is not a bad place to go to leave money. If you want to leave some money to charity, you know, let's talk through how do you max out the HSA? You hit the max in every year. You grow it for the future. You are paying for your medical bills outside of the HSA, and you're keeping track of those receipts. And before you die, you claim those medical receipts and you reimburse yourself for everything you can. And then perhaps there is too much. Perhaps there's some money left over. If you're charitable, that charity is a great place to leave as a beneficiary for your HSA. So when it comes to HSAs, there is a lot more to the HSA that you're probably missing out on. I don't see too many people actually maxing out their HSA. Most people tell me, I'm maxing out my HSA. They literally say, I'm maxing out my HSA. What they meant was, I signed up last year for my payroll deduction of $100 or whatever it is, and they're not actually hitting those numbers. They're not hitting the numbers of $8,300 for a family or $4,150. But let's say you are. Maybe you are actually hitting those numbers. That'd be great. If you're hitting those numbers, you're maxing out your HSA. Chances are you're in that lower interest rate account. You're not getting the highest interest rate. That's 100 times more that I saw. I did a study, let's see here, on May 22nd, 2024. That's when I looked at all the numbers. 100 times more in the top rated account compared to the other ones that are more common, actually. So max out the HSA, get the most interest, maybe grow that by investing it, hold on to those receipts so that you can reimburse yourself. That's the way to go about maxing out the HSA. Go to the Mr. Retirement YouTube channel because I've got the top HSA mistakes, the top HSA strategies to get the most out of your HSA, and rank through those 4 biggest HSAs, which one, number 1 to 2, 3, and 4. And really, there's number 1 is far above 2, 3, and 4. There's kind of no competition there. Number 1 is far ahead in terms of interest rates and fees. Maxing out your HSA is really one of the first things you ought to look at if you're trying to max out your retirement. Well, thank you for listening to the Retirement Revealed podcast. We believe if you know more about your money, you'll feel better about your money, and you will make better money decisions. Hi, I'm Jeremy Keil, owner of Keil Financial Partners. And if you're interested in seeing how we help our clients get more income, pay less in taxes, and avoid big retirement mistakes, make sure to go to keilfp.com. That's KEILFP.com.